Good afternoon. I'm Dale Medeiros, an environmental planner for the Northern Virginia Regional Commission. Taking part in today's webinar, the role of insurance in risk reduction and infrastructure resilience. This is the fourth of an NVRC webinar series on climate resiliency innovations for Northern Virginia. I'm lucky today to welcome Dr. Rakivir Vinokoulou, the Manager of Natural Catastrophe Solutions at Munich Re, and Ms. Prentice Darden, who oversees Munich Re's Resilience Domain Incubator. A little bit of context for today's webinar. The risk to critical infrastructure and property from extreme weather and climate change is rising. According to the National Oceanic and Atmospheric Administration, the U.S. has experienced over a dozen extreme weather and climate disaster events in 2020, each resulting in financial losses in excess of $1 billion. Fewer than a third of these losses were insured. This trend of negative climate change-driven disasters is likely to accelerate, and especially in our region, as this summer's flooding demonstrated. These events compel answers to questions such as how resiliency planning can be undertaken in regions like Northern Virginia that factor in a better understanding of risk management and insurance. Fortunately for us, Munich Re is a global pioneer and leader in finding answers to these kinds of questions. Development and application of innovative insurance solutions, risk analysis, financial advice that addresses extreme weather and climate change. The format for today's webinar is the same as usual. Rakivir and Prentice will speak for approximately 35 to 40 minutes, and we'll invite questions from all of you. The webinar is recorded, and the audience will be placed in listen mode only. But if you wish to ask a question, please park it into the chat box for Corey Miles to read and relay. Very special thanks to the Virginia Coastal Zone Management Program for their support for this activity. The webinar is expected to run until approximately 1:15. Thanks, Rakivir and Prentice. The camera is yours.
Thank you, Dale, so much. And thanks to Dale and Corey for having us. Very happy to be here. And welcome to everybody. And so one feature we're going to include in our presentation today is we're going to use Slido as a way to poll the audience. So it looks like we have quite a good group with us here today. So if you could, please take a moment and open a web browser and go to slido.com. And once you're there, you'll be able to enter this number here, 23074. You don't need to register or anything like that. You just go to slido.com and put in the number 23074 and keep that browser open, because throughout the presentation we have about 10 questions that we'll be asking, and you'll be able to cast your vote through that web browser. So we hope that you all can join, because it'd be interesting to see your thoughts and answers to these questions. So if anyone has any difficulty with this, please ask questions in the chat box, and we would be happy to help you. So with that, I will turn over the presentation to Rakivir.
Thank you, Prentice, and thank you, Dale and Corey. I agree that this is a great group, and we're really glad to be here and talking about the role of insurance and risk reduction and infrastructure planning. Going to the, we'll just get started, going to the first slide. Prentice and I, we strongly believe that the insurance industry plays an important role in making the world resilient. This is something which is a core part of our business, whether it's directly in terms of providing solutions, insurance solutions for homeowners and businesses and public entities, or indirectly through encouraging mitigation, right? And whether any kind of peril it is. So before, I think we will go to the next slide, and I think there is a question right now, correct, Prentice? Yeah.
That's right.
Go ahead.
Just started the first question. So again, if you open the browser at slido.com, you should see a question there on the screen, and you have several choices. It's multiple choice. So you can answer with yes, no, or I don't know, and we will see the results popping up there on the website. So great, it looks like we have some people that are putting in their answers there. So we'll give it a little bit more time just to give people a chance to respond. Looks like we have about 19 people that responded, so that's great. Just give it a couple more seconds here. Okay, great. So it looks like that was a lot of people do understand that there is an increased frequency and severity of flood events in the United States. So just a bit of a fact check there, and interest in seeing that. Okay, thank you very much.
Thank you, Prentice. I think that's definitely glad to see that. I mean, glad to hear that we're all on the same page. We're all seeing that kind of the increased frequency and severity of flooding events, but also natural catastrophes in general, whether it's the wildfires that are burning the western part of the United States quite a bit. I just read yesterday in CNN, there was an op-ed, and it mentioned about in terms of the area burnt this year due to wildfires is almost equal to the state of New Jersey. That was quite, and we think that it's already 2020 will already go into the history as one of the worst years in terms of wildfires. So I just wanted to start out with showing some numbers. Numbers always make the difference in terms of understanding what's at stake here. Just from and these are actually I'm sorry, there was a typo, but these are natural disasters from 2019. And these are the total number of events which include the severe thunderstorms, flash flood, winter storms, and so on, where the total estimated insured losses is about 25 billion, whereas the overall estimated losses in total added up to about 50 billion. So what's really like something that should be a takeaway from this slide is that even though the United States is one of the most developed nations in the world, we still see a major protection gap. And what I mean by the protection gap is that the difference between the economic losses and the insured losses is still almost 50%. And again, this is considering perils like severe thunderstorm, where the penetration rate, the insurance penetration rate is quite high, where for perils like flash flood, where the total economic losses were 10 billion, whereas the insured losses were almost 200 million, right? So and that if to put in perspective, also 2019, if you all remember, what has been one of the worst in terms of severity from an inland flooding standpoint. It's almost going to be one of the top 3 flooding events over the Mississippi River. Some communities and towns and cities were under flood stage, over flood stage for almost 200 days. So quite an unprecedented event in terms of flooding all throughout the Mississippi corridor. Going to the next slide. So this is a global view on floods. We're going to focus a little bit on floods here for this presentation so that we can focus on flood resiliency. But definitely that all the resiliency planning and climate change and the solutions that we offer are definitely transferable to other perils. But when we focus on floods, what you see here is a decade view, and what's the takeaway from this slide is flood is a peril that impacts almost the entire globe, almost the entire Earth's surface. And not only this, actually, FEMA would give a statistic saying that 98% of the U.S. counties have flooded over the last decade or so. What you're seeing here, as in the global view of floods, is a total overall losses of about 425 billion. And you would note from the previous slide, we know that in the United States, at least the flooding, for inland flood, the insurance penetration rate is low, and that's kind of the same in a lot of countries, except for some countries like UK, Germany, and recently in Australia, the take-up rate has increased. But overall, in other parts of the world, for example, in India, you would see that there has been a lot of flooding. The insurance penetration for flood is almost minimal, probably even less than 1%. Going to the next slide. And this is where we have the tropical storm view, and I put a tropical storm here because this is also a major impact in the United States in the last 10 years. We see the 2012 hurricane Superstorm Sandy, and also 2017 the Hurricane Harvey were significantly impacted. And you would notice the same, almost 50% or less than 50% of that was insured. Going to the next slide. So just a few more numbers. I mean, flood is really the most expensive natural disaster in the United States. As I said, 98% of the flood counties have experienced some kind of a flooding, and that's an interesting fact when you see a statistic like that coming from FEMA, because FEMA declares it as a flood only when they have to deploy resources to save. So when they say 98% of the counties have impact, and that means that it has impacted people and their properties. So 5 million people currently hold flood insurance policies, which is quite small, which means that out of about 130 million homes in the US, there is only 5 million homeowners that have flood insurance. So quite a low number there. Statistics vary, and the Insurance Information Institute says that about 12 to 15% of the homeowners have flood insurance. However, a recent study by Milliman, which is an actuarial organization, that found that actually that statistic is as low as 5% for single-family homeowners. So just about 5% of single-family homeowners have flood insurance. So that makes a huge impact. Going to the next slide.
Okay, so now we have our second Slido question. So again, for those of you that just joined, you can go to slido.com and enter the event number there. It's very easy, and you can go ahead and vote multiple choice, select your answer, and we'll see how this goes.
Yeah, I think this is more the same question as number one, but more focused towards your community. It seems like we have 21 responses, and 90% of them say that there is an increased frequency and severity of flood events. So, and that's something we have seen in the recent times, just last year as well. Extreme precipitation, also this year a little bit.
Okay, great. So we'll end that one. Thank you.
So just a bit more numbers when we talk about flood insurance and how the penetration, but when we start looking into even specific events, it looks even actually more startling numbers, right? Say like really Louisiana floods, for example, in 2016, 80% of them were uninsured. Hurricane Matthew had 60% uninsured. So what you would see here is that as the penetration is a little better relatively in the coastal regions, but as soon as these events go more inland, then there is the protection gap is huge. But what's surprising is you would notice is Hurricane Harvey, right? Even although that number that's a coastal region, Harris County, but there is a huge protection gap there, and there's several reasons for that. But one of the main reasons being that the maps are outdated in a lot of cases. The flood maps, the FEMA flood maps, are used to define whether a homeowner needs flood insurance or not. However, as FEMA has said before, right, and these maps definitely need a lot of updating, but at the same time, these maps were initially intended to only drive insurance related. It's not communicating the risk. So that's a major communication gap, a risk communication gap that we believe needs to be addressed if we want to address flood resiliency. We'll talk more in the later slides, but the thought where this would really give you a sense of, even when we dig into some of these specific events, the insurance protection gap is significantly high, almost averaging like 60 to 70% in most events. Next slide. Slide of question.
All right, we've got the third question. Does insurance play a role in hazard mitigation and/or resilience planning within your community? Okay, it looks like we have about half of the respondents saying yes, a third or so saying they don't know, they're not sure, and about 14% saying no, it does not currently play a role. Okay, thank you so much.
Thank you. So going to the next slide, Prentice, I think that when we
have one more, we have two back-to-back questions. So this is one of the back-to-back questions. So let's go ahead and see what people think about this one. Is climate change factored into the current hazard mitigation and or infrastructure planning process for your community? So that might be in land use plans or capital improvement plans, and looks like again, we have about 50% or so of respondents say that it is. About a third says no, but that it's important to think about continuing risk. And again, a lower percentage saying no. Okay, thank you so much.
Yeah. Thank you. So that was really important to know, those two questions, especially whether insurance plays a role and how does climate change play a role. From an insurance industry standpoint, our view about resiliency of communities is that there's two sides of the coin sort of thing. Both of them play an important role. The bottom-up thing and the bottom-up strategy and the top-down strategy, and that the bottom-up is really focusing on insurance penetration. We believe that insurance is a key financial instrument for resilience of community, which means to say that, or not just a community, but also for the homeowner specifically, right? As it's the worst case scenarios, that's what insurance is for, one for all for one, right? So, the more, if someone has an insurance for whether it's let's just take the example of flood here, then, and after a flooding event, people can recover faster. So let's just take example of Hurricane Harvey. The numbers said that on an average, people who did not have insurance, they received some kind of a grant or assistance from FEMA or local authorities of an average of somewhere around less than $10,000. Whereas homeowners that had flood insurance, they received about $110,000 that was the average claim. So the homeowners that did not have flood insurance and had a loss of more than 50,000, they must have had a huge burden because they didn't have any financial assistance to that level to recover. So that's one reason why we feel that insurance is key to the recovery of a community. There are other solutions that we feel that that can actually bridge this gap. Sorry. And the solutions are whether it's parametric insurance in terms of like protecting against some smaller events, but also there's a concept that we have been recently working on, is the concept of community flood insurance. What community flood insurance is all about is we know that there is a particular community that is doing taking some mitigation measures, and because they know their risk more better than anyone else, than even an insurance company. So if the community, because mitigation is not a one-size-fits-all, so this community takes some measures to mitigate some of the flood risk, not on an individual property, but as a community. And so what we can do is we can actually price the or structure an insurance solution for the entire community, so that the risk is evaluated for that particular community, and then the mitigation is factored in depending on what mitigation measures have been taken. So that's one innovative solution. There are many more. And that's the benefit of for us working with Munich Re, is that we have a global expertise. We have solutions from all across the world that we can transfer from one region to the other, and so there's a lot of innovative solutions that we look into, and especially, again, this is from a bottom-up strategy. The other thing is from a resilience, we think that mitigation and adaptation are key, right? Especially climate change. When we're talking about climate change, we know that the risk is changing. The risk is changing differently at a different level and in different communities. As insurance has always traditionally taken a role, your premium for the insurance is commensurate on what the risk is. And now if we have an external force, right, with something like a climate change that's changing the risk, that's increasing the risk, then the premiums are going to go high. So one of the things that we from an insurance industry constantly look into is the uncertainty behind this, and climate change poses a lot of uncertainty. How do we reduce that uncertainty? Is through mitigation and adaptation. So what kind of nature-based solutions can we think about? What kind of gray infrastructure can we think about to reduce the overall risk? Another thing, at the property level, it's very important that building codes are there. I think it's important as the climate is changing and as we see some of these extreme events happening, we should use these events as an opportunity to rebuild to a much better standard. If we do that, then the future, the losses will be mitigated substantially. But I think that's where there is a huge gap. We still have a lot of states that do not have strong building codes, especially for the peril of flood. It took more than 5 years of continuous extreme events from a flooding standpoint for a city like Houston and a county like Harris County to come up with building codes, which is right now put as all new construction will be enforced to have a building code of up to about 2 feet above the 500-year level. The other point when we talk about resiliency from a top-down perspective, it's also public-private partnerships. There's multiple ways to look at it. There is risk pool options, and there is what we call it as a resiliency risk transfer. That's a concept that Munich Re has been working on, and I'll give you more details in the next slides. Let's go to the next slide, Prentice.
Okay, question number 5, we'll do this quickly. So again, you should see this, the next question come up. Is flood resilience a priority topic for your community? Okay, looks like yes, across the board it is fairly important. Around 70% say that it is. A few about, you know, equal numbers saying no or I don't know. Okay, great. Thank you for that.
So when we talk about the insurance penetration rate, I wanted to give a little bit of an example of flood insurance, a product that Munich Re has. I think a lot of people may think that the only way to get flood is through the National Flood Insurance Program, which is still a primary source. But also recently, and the last term since the Bigger Waters legislation in 2012, I think there's a lot of private market solutions, but most of them are standalone. What we have a product which, but especially when we are talking about flood insurance penetration, as I mentioned earlier slides, that the insurance protection gap for flood is higher in the inland areas as compared to the coastal regions. So one solution that we offered from a Munich Re standpoint is what we call it as an inland flood coverage. We know that the risk for the low and moderate risk flood zones is lower, right? So but the solution for them is in the way the NFIP is set up. The average premium for the low and moderate risk flood zone can exceed about $400 per year. But we wanted to offer something more reasonable so that there is at least a little protection that homeowners have instead of no protection. So when we did the analysis, we found that the losses in the low and moderate risk flood zone accounted for about 25% of the claims of the NFIP. And but the average losses were not that high. So what we did was we came up with an insurance product, which is an endorsement to the homeowner's policy. That's another benefit, which I'll come to it later. But basically, the limits are low, about $5,000 to $50,000 of coverage. We offer this through our clients, which are the insurance companies, and it's an endorsement to your homeowner's coverage. And you can choose between $5,000 to $50,000 of coverage. The benefits of them are basically, of course, the main benefit is the premium. The premium is about less than $100 in most cases, unless the risk is more. And again, we have a little bit more details than just the FEMA flood map. We take the flood map, we see whether it's a B, C, or X zone, which is the low and moderate risk flood zone, and we also look into the risk scores within that flood zone. And based on that, we come up with, and there is a benefits like the loss of use. We have a sublimited coverage of 15,000, and also the basement is covered in these regions. The benefit of this product is, again, we feel that as climate is changing, this is going to be a very important product. One of the benefits, as I mentioned briefly earlier, is that this is an endorsement to the homeowner's coverage. So this flood insurance has one disadvantage and one of the reasons why the flood insurance penetration rate is low is, of course, people don't know their risk, but also the point of sale for flood insurance is different than the homeowner's coverage. Or there is actually no point of sale unless there is someone's house is in the special flood hazard area, and they don't even know that they could get some flood coverage unless they ask for it. But we are promoting this through our insurance company, so this is endorsed to the homeowner's coverage. So there's some level of protection, and particularly we found the benefits as recent as in May when the 2 dams breached in the state of Michigan. There were about 10 to 15 homeowners that had our flood product, and they were in the X zone, which is low risk flood zone, but they still got impacted. So yeah, this is one solution that we offer. We feel that the insurance penetration rate should be increased. Again, addressing into the bottom-up strategy. Going to the next slide.
Okay, we have the 6th question. We'll look at this real quick. It should be a quick one. Do you have flood insurance? A few reasons why you might not have it. Curious to know. Also taps into the knowledge of flood risk and whether or not you have that. If you know what your flood risk is. Okay, we have a few responses there. We'll give it a few more moments here to gather a few more responses. Looks like quite a people do not need to have flood insurance.
Yep. That's generally kind of the responses that we have seen, and thanks for this. Being a hydrologist by academic training, one thing I would like to say is there is a flood risk almost everywhere. We saw it in one of the earlier slides, and as I mentioned, 98% of the counties in the U.S. have flooded. Of course, there may be some mitigation steps there, or that homeowners have taken, or the houses are elevated. Those are different ways that the flood risk may be almost minimal, but there is almost flood risk everywhere. I've personally seen examples of homes that are flooded in the mountains of of Colorado, so in the Rocky Mountains. So and even in New Jersey and Lampville, there's a house on the hill where because of flash flooding due to Hurricane Irene, there was like immediate flooding within the home, right? And although this home was right on the hill, so.
And then the next question we have is related to building codes. So is your community considering either adopting or updating building codes to address future changes within the community's resilience plan? So this gets to the fact where many municipalities do not have a resilient building code. So we are curious to know where this group stands in terms of your knowledge of that. Okay, so it looks like quite a lot of people don't know if that's the case. Let's see, we have a few more answers coming in. I'll just give it a few more moments before we wrap this one up. Okay. Okay, great. Thank you so much.
Great. Thank you, Prentice. So, yeah, this is somehow we're not seeing the animation here.
Sorry about that. I think it might not be animated.
Yeah. Well, I'll try to see how I can explain it, but I think this graph is the most important thing in the slide. So this is, as I mentioned, a concept called risk. So this is more from both from a bottom-up, but also from more from a top-down strategy. It's almost like a public-private partnership, where we say, how can we combine risk transfer and risk mitigation? Traditionally, these two concepts have been approached in silos, right? Either someone is thinking about risk transfer or someone is thinking about risk mitigation, especially in a public entity. But we came up with a concept called the resilience risk transfer. This was a paper, a collaboration between in Mexico and the Nature Conservancy and Munich Re, but also in a university in California. There's a paper in the ecological economics. This concept itself was focused towards coral reefs. The way it's structured is if there is, let's just assume that there is a wetland, and we're going to focus on floods, and we identify that the wetland actually has benefits in terms of reducing the losses from a flooding event for a community. But right after any event, wetlands also suffer some damage, either directly because of an event, but also because of warming climate, warming temperatures. So if they identify that the resilience investment, which is represented by that yellow bar or the orange bar there, then we say that, okay, it takes a certain amount of investment to restore the wetland, which actually has benefits in terms of reducing the risk to a community. And that is what is represented by those red bars, and the blue being the reduction, the risk reduction. So if, let's just say, for example's sake, let's say I'll put some numbers. If the first red bar, the amount at risk is at a number of 100, and in year 2, and those are the phases. So it takes time for the restoration of the wetland. So let's say in year 2, it has been a certain amount of restoration done, which provides a benefit of about 20%, let's say. So then the risk and the risk has been reduced to 80 and in year 2, and so on in year 3. Let's say if it reduces to 70, 75, and going down to again 50 or 40, something like that. So, but the benefit is in this particular concept is that what we say is the risk reduction, the reduction in the premium, is kind of amortized as an investment back into the resilience investment, which is initial as part of the initial wetland restoration. So that I mean, the graph is not to scale here, but that's the benefits is that we say that whatever reduction that the risk transfer gets is amortized back into the investment. So that's a way of thinking about it. This, again, as I said, this is transferable to other regions, other perils, but also other like natural infrastructure, for example, because the study was done for coral reefs, and this could be transferred to wetlands and some other nature-based solutions. Going to the next slide.
Okay, so we have 3 questions left, so I'll go ahead and put this one up. And if you are trying to answer the questions but aren't able, go to slido.com on a web browser and enter this event number here. And through the web browser, you'll be able to respond to the question. We're wondering, what time horizon is your community using for resilience planning? How far into the future are you looking at in terms of what sorts of resilience investments that are needed for infrastructure, all sorts of things, just to get a sense of how far in the future you're thinking. Okay, looks like we have a little bit more of people who are working with the 2050 timeframe, a little bit less with 2070, and the fewest at 2030. And about half of people don't know. Okay, great. Thank you so much. Okay, thank you.
Yeah, I may skip some slides in the interest of time, so that we could also have Prentice present some of the innovation stuff that we are working on. But some of the questions that are really important, especially when addressing the insurance as well as the climate change. The insurance and reinsurance products are developed and priced based on the past history. So that's one of the things that is the current case. So I would like to bring to your attention one of the articles in the Wall Street Journal in October 2018. This was about how is the insurance industry looking at climate change. Our chief executive for reinsurance was also quoted in that. And for us, the question has never been about if there is climate change. In fact, we have been, from Munich has been addressing the issue of climate change since the 1970s. In fact, with the peril of flooding in Germany. So so far, the signals, the climate change signals have been small, increasing, but small in terms, and specifically focused on certain area. But then recent events like Hurricane Harvey and other events of Hurricane Florence and other region, and the wildfires also, are basically forcing the insurance industry to question whether that is enough to just look into the history in terms of coming up with the products, because the signal is very strong in certain cases in terms of the extreme events. So of course, the law of large numbers makes some lines of business very stable, but especially addressing something like flood and wildfires, it's a major concern. How do we address this into our underwriting process? For perils that there isn't a lot of amount of historical data, that's also another concern. What we do is we use stochastic peril models. So we have flood models, for example, to fill that gaps. But again, the question is, how do we incorporate in terms of the extreme events, especially for these perils where there's not a lot of historical data, but in terms of the granularity. But what if the future climate is not the same as the past? Are natural catastrophe events becoming more frequent? I think you all answered yes. Are natural catastrophe events becoming more intense and severe? That also is an answer is yes, because we have seen, especially for flooding. And one thing interesting about flooding is that in the recent years, in the last 5 years, since Hurricane Harvey, most hurricanes are now being considered flood events rather than wind events. That has been a change that has been seen since Hurricane Harvey. One other thing about talking about the future climate is not the same as the past. I also just remembered that there is a paper by Professor Kerry Emanuel in terms of the annual probability of Harvey-like events. Although most of the models considered look at the data in the history, and so when he analyzed the data, Kerry Emanuel is a professor at MIT. What the data showed was that the Harvey-like events had a annual probability of about 1% in the 1980s. That probability with the IPCC scenarios, the different RCP scenarios, if he takes the worst case scenario, by 2080, which is like after a century, that is annual probability increases to about 16 to 18%. That's quite an increase, and so if when he did a linear change, he found that about 2017 Hurricane Harvey would have had some kind of an annual probability in the range of about 6%. So it shows that some of these signals are very strong, and we need to address that into our underwriting, and that's what we have been focusing on with a lot of data analytics and with a lot of models. And so one of the questions is going to be, what is the impact on a one-year insurance contract? Because we all know that insurance is done on a one-year scale and not on a multi-year scale. There's benefits and there's pros and cons for that. Pro is, it's beneficial because we don't, we can at least address the if there is a volatility and uncertainty in an extreme event, then we can at least reevaluate. But if we offer a multi-year contract, then at least we can kind of capture some of the signals, climate change signals. Going to the next slide, I think we can skip some of these slides, Prentice, and maybe get to your section. And a lot of these are based on some of the extreme events, and especially addressing extreme precipitation. But I think this is one example of like where flood and earthquakes are a major concern. That's also something mainly in California, but now Virginia had a small earthquake. But the aging infrastructure is going to be a major concern, because if the like even the dams and the levees in the Mississippi River, over the Mississippi River, most of them were put in place, especially in the northern part of the country, were put together in the 1930s, 1940s, right after the 1927 Great Flood of the Mississippi. A lot of this infrastructure is aging. The average, I think there was about a New York Times article in 2011 focusing on the dams and the aging infrastructure, and found that about 4,000 dams were at a critically high level of threat to in terms of failure, and that's going to be a concern, right? And this is an important point, this about what if cities, states, and countries do not adapt to climate change. And I think that goes to most of you probably are aware about Moody's, and we can go to the next slide, Prentice. The Moody's and S&P have done some studies on how this is going to impact some of the bond ratings for cities and towns. I think the study by S&P was really interesting, where they found that extreme events can have an impact on the sovereign rating of a country, of a nation, by about 2 notches if they do not consider that in their planning. All right, let's go to the next slide of question, and then I'll pass it on to Prentice.
Great, thank you so much. So this question is your community thinking about risk transfer to address cash flow and immediate liquidity needs? So how much is risk transfer a part of the conversation in your community? Looks like a lot of people don't know. A few respondents coming in here. We'll give this one a few more moments.
I think the thought process behind this question was, and I wanted to put that here, is because we have in recent conversations, what we have found is Stafford Act is really put in place. I mean, definitely helps the cities and the communities and the states to recover after an event. However, I think there is still about 10 to 20% of it, the burden still falls on the community. But also, in the recent conversations, we found that the average delay in the federal funding assistance coming to the state level or the local communities level is almost about 24 months right now. So that's really the background for this question. Okay, so we do have a parametric coverage. I think I put this in perspective, but parametric coverage is really interesting because it can bridge the gaps. If I focus on just public entities, there is some coverage gaps with the cleanup costs, for example. What happens, so in Hurricane Irma, the county of Sarasota faced almost $6 million of cleanup costs right after the event. So who pays for that? Who's going to cover? So there are some unique solutions like parametric coverage that could, and at the homeowner level, there could be solutions like evacuation, which goes into, well, people don't evacuate when a hurricane, but that's mainly because they do not have, it gets into their affordability. Who is going to pay for lodging? Who's going to pay for airfare? Because that is more expensive at that point. And what about the incidentals? So these are some other like coverage options and instruments that we think that can fill the gap in terms of addressing natural disasters and the resilience of communities. Next.
Okay, thank you, Raghavir. So let's see, we just have about 10 minutes here. So I will speak to you about the work that we are doing in Munich Re's Incubator and how it dovetails with Roggeweer's work in the reinsurance division at Munich Re. So we know that there are a lot of factors that go into the affordability of insurance and how many people are then purchasing insurance that can help them deal with the financial strain of floods. And we also recognize that we need to work at a municipal and regional level to provide protection, right? Because it really isn't about each person protecting their own property for the sake of protecting themselves, right? There's the famous image of Louisiana where someone has built a berm around their entire house and the floodwaters have risen all around. So when floods come, we know that infrastructure networks are vulnerable. And so whether energy is being delivered to the home, whether or not the sewer system is working or water supply system is working, these are things that cannot be dealt with at the property level. Waterfront protection is very much a district and municipal scale project. So it's these three factors together that really require an understanding of what we can do to build more flood resilience. So basically, the work that we're doing in the resilience domain within the incubator is about developing market-based solutions to flood resilience projects. So I should say I'm one of the co-founders within the incubator, and there are 4 others within the resilience domain, and then Ingo Pischitz-Reiter is the domain leader. And so all of us are working on resilience to natural catastrophes. So I happen to be working in flood resilience. My background is as a landscape architect and working at a civil engineering firm prior to joining Munich Re. But big picture here that I want to get across is that it's about the combination of reinsurance and insurance. It's also about the efforts that public entities are doing, which are hugely important in the planning, design, and construction of resilient infrastructure and communities, as well as market-based services that can fill some of those gaps. So, the big question for us is how do we solve some of the resilience problems that are held by both businesses and public entities to build flood resilience and to have a future that is less destructive? Some of the questions that we are grappling with as we develop these ventures, I should say we do go through a venture development process, just working on the lean startup model, that sort of thing. And so the questions that we are grappling with is how to encourage people to invest in resilience today to avoid spending more tomorrow. So there's a behavioral science component to this that we're really interested in cracking. How do you convince someone that it's really a good idea to spend some money today, and being able to communicate to them what that future risk will be. And of course, it's about probability and not being certain. So what are the compelling statements that help people to build resiliently, right? So we want to not only, we don't want to just have cash available when a disaster hits. We really want the losses overall to be reduced. So how do we build how do we mitigate? How do we build more resiliently? And how do we do this in a way that addresses equity issues? So we know that socioeconomic factors absolutely come into play, and we know that lower income, more under-resourced neighborhoods are built in places that are more vulnerable to flood events, to all sorts of issues really, but within this context, more vulnerable to flood events. So how can we address that? How can we ensure that the solutions we're coming up with are not only for affluent communities that might see a higher return on investment for their property value? We really want to be addressing all aspects of a neighborhood and a city, because that is true resilience. And we also are looking at how we incentivize resilient construction. So what are the things that, what are the problems that are held by cities, by real estate developers, by corporates that are that are constructing their headquarters and new communities. You know, how do we work with all of those entities to really incentivize the construction of something like here you see Bishan Park in Singapore that provides an enormous amount of flood protection, water quality improvement, recreational opportunities, and also heat mitigation, right? So we know there are many benefits that go into the construction of resilient infrastructure and communities. And just have a few minutes left here. So during the past few months, we've been having lots of conversations with all sorts of people that are involved in resilience and are dealing with problems of flooding. And so these are some comments here from different public entity groups. So we've spoken to people in Florida, Texas, Virginia, New York, New Jersey, Mid-Atlantic, and you know we're hearing what people are really concerned about and where they are, what their vision is for the future, what they're working on. So we wanted to share some of these comments with you all to give a sense of what we're hearing. See if it sparks anything for you, or you see other people are having the same struggle, or maybe looking at the same opportunity. So one of these questions is, you know, how do cities or owners of critical assets, how do they get credit for the resilient, for the typo, but for the resilience work that they're doing? You know, can they get recognized in bonds and insurance rates? So part of the dynamic that this is speaking to is, you know, we have the credit rating agencies like Moody's that are saying they will be downgrading the credit of municipalities that don't plan for sustainability, plan for resilience, and I would assume also implement those plans, right? And really get those projects built. So we want cities to have good credit, of course, because we want them to be able to afford building resilient infrastructure. But if they aren't getting credit for the work they are doing, what can we do? Is there anything we can do within the Munich Re Incubator or within the reinsurance division to then enable a system where the lens is a bit sharper and okay, we can see that resilience work was done to reduce risk, and so then how can we capture that value and reward that entity for the work that they've done? Another question that came up, how do we sell incorporating resilience to the development and construction community, right? So, you know, real estate developers have a lot of costs when it comes to building, and, you know, trends have been varied. You know, there have been varied trends that, you know, for a while, sustainable building was more expensive, and now it's less expensive to build sustainably. And to incorporate resilience measures might have an initial capital cost up front, but it has a lower operating cost, which then you can see a return more quickly for that investment. You can see some of those avoided costs in the useful life of that asset. So, you know, this is a question that came up from a county, and that's something that they're grappling with. How do they really engage the real estate and construction community to build resiliently? And the last comment here, this came from an agency, and we're seeing this echoed across other agencies and people from different agencies and counties. The fact that they are disincentivized to invest heavily in flooding because the primary driver for the investment is for water quality through the Clean Water Act. So we know the Clean Water Act is very important. We know we have the problem of combined sewer overflows in many of our communities. And we know then that public entities are legally bound to do something about that through a consent decree, right? So they have to pay money to clean up the water quality. So that creates an imbalance then where projects that are designed to improve water quality have priority over those that are meant to mitigate the water quantity side of things and the flood mitigation side of things. So what needs to happen to allow the flood mitigation projects to rise in priority? So that concludes these comments that we've been hearing. And we have one last Slido question, and then I think we're right at time for Corey to conduct a Q&A. So thanks to everyone who stayed with us. Here's the last question up on Slido.com here. And this points to the business role and the private sector role that could be engaged for resilience planning and creating resilience in your community. So do you think that corporates in your community should play a more active role in resiliency planning, or the factors that are most attributed to climate change, flooding, heat, and sea level rise? So maybe corporates are engaged in your community, maybe there are discussions about them being engaged in the future, maybe you're not sure what role they might actually play.
Yeah, and that's a good point, Prentice. I think the background again here in this question is we would like to know a little bit more if there are already interactions. Of course, there might be some NDAs in place if that's the case. But if there is no NDA or anything that you think that Munich Re can be involved and to further the discussion, I think that we'd be happy to. So that would be great. So yeah, sorry, back to you, Prentice.
Great, thanks, Robert. Yeah, I think it's a very interesting trend that we're starting to see as well too, because when companies rely on a big workforce, how that workforce is able to respond to flood events is also important for the productivity of the business. Businesses would want to be located in communities that have lower future risk, just to reduce business interruption and increase business continuity. So, thank you for that. And that concludes the presentation portion. And so Corey, I believe, is going to now do the Q&A for us.
Yes, I am going to do the Q&A now. I'm just opening up the questions box. Here we go. Let's see. We've got a number of questions here. I'm going to start with the first one. Is there a way to see who is already insured in an area, or to have a percentage based on population, and that's regarding flood insurance, either required or optional?
Yeah, so unfortunately, the only statistic that we can get in terms of the insurance penetration would be through the NFIP. There is statistics that are available from I think from a zip code level and that FEMA shares, but we can't get more granular than that because of the privacy laws. But yeah, but overall, state level, county level, the data is available, and within the state and county level, with what risk zones are these homeowners in? Yes, that's also available.
Okay. So Prentice mentioned in your slide with all the questions, one of which was water quality being a driver of investment for a lot of municipalities because of the Clean Water Act. And somebody wrote here, Aaron wrote one answer could be the better quantification and documentation of co-benefits or all of the ecosystem benefits afforded by nature-based solutions, i.e. living shorelines.
Wonderful. Yeah, I think that's a great suggestion and comment, and something right in terms of being able to account for the co-benefits or the environmental and social benefits there, specifically with shorelines. That's great. I think one thing that I kind of realized recently that's interesting is when I think when we speak about green infrastructure, the one sort of metric that people focus on is increased property value, right? Because it's the metric that then can be pulled in from the design into sort of like financial statements. And I really love the work that's going on around triple bottom line accounting. But, you know, it's so interesting to think, I think that the property value is not as much related to the flood reduction that the green infrastructure does, but more so because the increased vegetation provides an improved aesthetic, access to it provides open space that people have access to, it provides recreational opportunities that people have access to. So I do think there's more work to be done and compelling cases to be made with monetization of those environmental and social benefits. So thank you for that.
Yeah, and along the same lines, green infrastructure is just as much a part of a city or a municipality's infrastructure as, you know, sewer lines and you know, water lines and these types of gray infrastructure. Are there insurance products that could help to ensure those types of investments as well, because you don't typically think of, you know, plants and trees and you know, natural things being insured. But for example, there's a lot of stream restoration projects that municipalities in this area are implementing. Can that work? And those materials be insured? Or could they get a credit for, you know, is there a way to factor that work into your overall portfolio?
I think, as I mentioned about the resilience risk transfer, Corey, I think that would be an innovative way of factoring in these infrastructure, this natural infrastructure, into the insurance, because now you're basically combining that along with which is provide an infrastructure that's providing mitigation to the risk transfer. So if we identify what that risk transfer is and which community actually kind of gets the benefit from this natural infrastructure, and factor this natural infrastructure into the resilience investment, as I mentioned in the slide, I think that would be a unique way to factor that in within an insurance landscape.
And to build on that just a bit, you know, one thing that we are interested in doing is to, you know, work with communities to help prioritize the resilience projects. So for example, we were looking at the Hampton Roads Resilience Plan recently and saw that phase 2 or phase B, excuse me, don't know exactly which one, but the second phase had a list of pilot projects. And so, you know, if we could provide some information, you know, from an insurance perspective and from a financial perspective to indicate, you know, which of those resilience projects would provide, you know, would provide protection from future flood losses, both, you know, economic and otherwise, you know, that would be something that we would like to, you know, be able to provide that information. And we've had a few people ask if we could do that for them. So that's one way that we would like to support the work that public entities are doing.
Okay. Now let's see, we've got a few more questions here. Okay, from Arlington County, we have heard frustration and bewilderment from homeowners who had flood insurance but found out that the various exceptions left them without coverage after a very localized or internal flooding event. For example, when only multiple properties have to flood, sanitary sewers need to back up, basements not covered from walkouts, etc. It can be hard to push the buy flood insurance message when we hear these disappointing stories. Are there any good online resources available that can help explain what those typical exceptions or requirements are?
Yeah, I think generally if you type in Munich Re inland flood endorsement, you'll get to a website where it provides all the details about what's covered, what's not covered, Yes, I totally understand the frustration, and but at the same time, I feel that one of the problems, it's kind of like a catch-22. There is not, and that's going to reduce now because of the private market solutions. But overall, what we have seen as private market solutions are much broader in coverage, even though they might not offer 100% in terms of the basement, but there is at least some sort of sublimits available. But yes, there is a little bit also from a Munich Re standpoint. What we are pushing is a lot of education and resources in terms of training for agents, because that's also where the buck stops, because with the agents, because they have to ultimately let the homeowner know. And this kind of falls back everything into the risk communication for the flood piece. What is the risk? Is something that people are still not aware of, and I think that once that is addressed, and once we have more insurance penetration rate, I think a lot of these issues will be resolved.
Okay. Let's see now, for inland flood insurance outside of the FEMA floodplain, what is the average cost for a homeowner to buy basic flood insurance as an add-on?
In terms of the premium, or is it the loss, the total average losses?
Let's see, probably the premium average.
Yeah, the premium, I think the premium varies quite a bit. It depends on, I mean, if you take a coverage that's standalone, that would differ in terms of a little bit, like as I mentioned, the NFIP on an average policy for a BC and X zone, the low and moderate risk flood zone would be at least around $400 or higher. But there are solutions like, as I said, the Munich Re inland flood coverage. You can, I mean, there are certain companies that cedent companies that provide our coverage. We retain all the rest, but the product is sold by the insurance companies. So if you talk to your insurance company about an inland flood coverage product, you will know. And in those cases, the endorsement we are offering only about 5 to 50,000. The homeowner can choose. Those premium numbers are less than $100 per year.
Okay. And then as an additional question to that one, if more people buy into the insurance, does that drive the cost down? Because ultimately the costs/benefits of creating a more resilient community cannot protect against all flood scenarios. So the next logical step is to work on getting residents to buy flood insurance, even if they're outside of the floodplain.
Yes, I think that's a really, really good question, and I think that the answer to that is theoretically yes. As the protection gap narrows down for the peril of flood, as more people take flood insurance, the cost should drive down, because now the correlation that we don't have the volatility, right? So it's not like there's a huge event and there is only major properties that are the properties that are in a high risk zone are only the ones that are flooded. If the risk is distributed across, then overall there is enough premium to cover the cost, and as I said, theoretically that reduces. However, as I mentioned earlier in the slide, I think one of the challenges that we all are seeing is also the uncertainty because of climate change. And unless we address the building codes and risk mitigation, I think that is also a very important factor. And I would strongly encourage everyone to talk to your representatives and say, well, the building codes are really important. As we see these major events, as I mentioned earlier, let's take this as an opportunity to rebuild stronger.
Yeah, and maybe as an add-on to that question, you know, as a private citizen, we typically don't have any impact, or we don't have any control over what the building codes are. Those are, you know, governed by local officials and even at the state level. So if there is an overwhelming evidence that the building codes are not sufficient to handle a specific peril like flooding, would that make a county or a state liable to pay for those costs if there is a loss for a flood event?
Don't know if I am the right person to answer that question. So if the question is that if there is no building standards and codes in place, if who's liable when the risk has increased because of climate change, correct?
Right. Well, if the building codes do not keep up with the conditions.
Exactly. Well, I don't have that answer for that question. However, I do want to mention, as of just September 30th, there was a bill that was introduced in the House, I think, which it's Representative David Price and Lee Selden on Flood Resiliency and Taxpayer Savings Act of 2020. So I think these are the kind of bills that we should support as thinking about resiliency, thinking about mitigation, and what kind of tax benefits or anything can help people think about or adopting mitigation within their rebuilding process.
Okay. Well, that concludes the questions that we have in our chat box.
I think one thing I would like to say is, I mean, definitely we wanted to, Dale and Corey, thank you so much again for this opportunity. But this is our intent is not just to have a conversation just for today and not like a presentation. Our intent is to promote more conversation. As a global reinsurance company, again, we have vast amount of data and experience from the globe, and we're here to help. And if there is any way, and we are thinking about these solutions and how can we help, but I think where the gap has been that we see is these conversations between the public entities and Munich Re or and the insurance industry particularly. Let's have these conversations more. I mean, if you want to reach out to us, definitely social media. We are both on LinkedIn and Twitter. But also, if you want to directly reach out to us, our first initial and our last name at munichre.com. That's our email. Yeah, sorry, we should have put it on here, but if you Google it, you should also find our emails out there. So no, thank you so much again, and I really enjoyed this, and I hope this would be just the starting of a great conversation ahead, and hopefully better solutions for the communities in Virginia.
Thank you.
Thank you so much.
Thanks everyone for having us. Thanks to Dale and Corey for hosting.
Thanks everyone.
All right.
Thank you.
Thank you very much. Have a great afternoon.
Thank you.
Bye. Thank you.